This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, December 4th at 7:10 a.m. Mountain Time. This is the free version of our weekly audio summary from our weekly note. Well, this one's a little bit more than a weekly note. It's the 2024 Outlook titled Put Pause Pivot, a reference to the Fed policy path, expected Fed policy path. Now, one important housekeeping note for all you free subscribers, we are going to release this monster of a note about twice as long as typical to the public in a week's time. So next Saturday morning, you will get the Outlook note a week behind our paid subscribers. We're not going to release our macro themes note or our year in review note in its entirety to you. And obviously you don't get the whole notes through the course of the year, but there's an awful lot of Outlook notes out there, and we think we do a really good job around it. We spent a lot of effort on it, and we'd like you to see it to hopefully entice you to consider becoming a full paid subscriber. So look for that next Friday morning. I'm going to walk you through the key forecasts from the note. Those were available to you in the free preview, and then I'll contextualize the note a little bit. And then you can read the whole thing when I release it to you on Saturday morning. So our key forecast for 2024, first for inflation, we do expect continued disinflation in the core. A lot of this is obvious as the shelter measure continues to go through its lag impairment process and discount rents that have already come down quite a bit over time. But we think that it's likely that inflation only gets to the top of the Fed's, call it 2 to 3% comfort zone. We may overshoot a little bit around mid-year, but then we're going to find inflation sticky above where the Fed would like it to be with that goofy 2% target they set back in the deflation scare days in the aftermath of the financial crisis. We think unemployment is headed well above 4%, and this is going to be the trigger for the pivot. Growth, we see both consumption and investment weakening. We don't think they'll go decidedly negative, but they're both weakening, and that will play a role in the earnings outlook as well. Earnings are likely to be weaker than forecast in the first half of 2024. Our leading indicators are headed down right now, things like discretionary net revisions. That's what drove the recovery from the October 22 low, or part of the process at least. But we see those as actually headed south right now. So there is some risk of a double dip earnings recession. We don't think we'll get one, but we don't think we're going to achieve market consensus of low double digit earnings growth next year. We think the first Fed rate hike will come in March. There's about a 50% probability of that being priced. And we think we'll get at least 100 basis points next year. That's absolutely crucial that the curve is disinverted the old fashioned way, which is through a bull steepener, meaning the Fed cuts rates and that loosens the bank credit channel. We think the first move for the S&P 500 is likely lower, first 10% move that is. And so we have the market going down to 4,100 before finishing the year much higher at 5,100 in a path similar to 2009. Clearly not as acute, but we do think that 2009 path is a reasonable way to think about the markets, where it trades down for the first quarter, stabilizes, consolidates, and then moves higher later in the year. We think the curve will disinvert around mid-year, but at the end of the year, 10-year note yields will be higher than they are right now. We still have a massive imbalance of supply and demand. As far as sector allocation goes, for now, we're sticking with overweight industrials, materials, and energy, underweight financials and small caps, market weight on tech and related, and still underweight those defensive sectors. But we expect, if we get the scenario that we think we're going to get, which is Fed starting to fail on their employment mandate, market getting concerned about a recession again, that at that point you might be able to reduce your tech exposure, increase your exposure to small caps and maybe financials, although the overhang with financials from regulatory policy is really going to be dependent upon the November election. And so we may struggle with financials through the course of the whole year. So that's going to be it for me. Bearing up from Ironsides. As I said, we're going to release the whole note to you on Saturday. Please, by all means, look through that. Look through all the work we put into it and consider becoming a full subscriber for 2024. Have a good week, everyone. Bearing up from Ironsides. Thank you.